Welcome, everyone. On behalf of Frontier View, thank you for joining our webinar series. On today's webcast, we'll be discussing the outlook for Asia Pacific in 2021. As a reminder, if you're a client, you can access all of our research and data on your Frontier View desktop and mobile applications simply by logging on. If you're not a client, we're offering complimentary trial access to Frontier View to registered attendees of this webinar. To take advantage of this offer, please request a trial in the comment box or visit our website, www.frontierview.com, and click the Request Trial button. Before we get started, we realize that some of you may be new to Frontier View, so I'd like to take a minute to provide you with a quick overview of our firm and how we support multinational executives. Frontier View is a premier global market intelligence and advisory firm. Our primary focus is on serving the market intelligence needs of global business professionals at multinational corporations by informing and empowering their market monitoring, strategic planning, and international growth priorities. From the beginning, we built Frontier View to be different in three primary ways. First, our product and service model has been purpose-built to serve a global business audience. In every aspect of our work, we strive to separate signal from noise and answer the so what, now what questions that are unique to the international business professional. Second is our model, which we call Strategic Intelligence as a Service. Frontier View is the only market intelligence solution that bundles together information resources, analyst advisory access, and senior executive network events. Finally, we're especially proud of our world-class technology, which powers the Frontier View desktop and mobile applications and has been built with the sole purpose of informing our clients' workflows and decision processes. We're also incredibly proud of our client base, which today includes a growing community of over 4,000 global business professionals, some of whose companies you see here. Again, if you're not a client and are interested in receiving trial access to our Frontier View program, please visit our website and click the Request Trial button. Having briefly introduced our company, I'd like to take a moment to introduce myself. My name is Adam Jarzik, and I'm the head of research for Asia Pacific at Frontier View. As the leader of Frontier View's APAC research team, I support senior executives on key initiatives, including strategic planning, resource allocation, and risk management, among others. Because I'm in constant contact with our clients, I'll be discussing not only the results of our research, but also what we've been hearing from multinationals who are preparing to navigate a volatile 2021. If there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team, Sarah, Raveen, Althea, and Yuchen, will be happy to follow up with you directly. And with that, I'd like to turn now to the agenda for today's webinar. Our webinar today will consist of a 50-minute presentation followed by Q&A. To be specific, we'll begin the session with a discussion on the shape of recovery in 2021. During that portion of the presentation, we'll discuss how Asia compares to the other major regions in the global portfolio, how forecasts for markets around Asia have been shifting, and which markets are likely to experience the strongest recoveries in consumption and investment. You can use this information to manage corporate perceptions, clarify recovery timelines, and inform conversations on portfolio allocation. Once we finish that section, we'll spend a little time talking about how COVID is affecting behavior across markets. Specifically, we'll discuss how people are responding to COVID outbreaks, and critically, the fear of COVID outbreaks. Responses vary substantially across markets, and a clear view of these dynamics can be very helpful for informing conversations on demand planning and digital investments. Finally, we'll offer a brief update on the US presidential election, where we'll give a clear view on the outcome of the process and the future of US tariffs on China. Once we've shared this content, we'll round out the webinar with a Q&A session. So if you have any questions or points of clarification regarding any of the topics we cover today, please don't hesitate to send them to us at Frontier View Webinars via the GoToMeeting Messenger by clicking on the Q&A box on the right-hand side of your screen, and we'll do our best to ensure that they're addressed in the Q&A period. All right, without further ado, let's get started with a discussion on the shape of recovery in 2021. Now we know that plans, strategic plans, Operating plans are only as good as the assumptions underpinning them. So we'd like to begin by outlining our assumptions. I won't read through all of this text, but basically we're going to assume that there will be multiple strains of the virus, but that it's not going to become dramatically more or less virulent over time. We're not going to see a lot of people who were not at risk suddenly become at risk. We're not going to see a lot of individuals who were previously very much at risk suddenly become not at risk. Similarly, we don't expect there to be large-scale reinfections of people who had an earlier strain. Any of those outcomes would have the potential to substantially shift timelines and forecasts. We expect multiple vaccines to receive approval by early next year. Indeed, it may even happen by the end of this year. Production will ramp up at about the same time. So we believe that'll happen starting in Q4 of this year. And distribution on a mass scale will begin in the first half of next year. Not everybody's going to get that vaccine at the same time. Wealthier, more developed markets and some major emerging markets will secure access to vaccines first. When we look beyond those markets, we see mass global distribution taking place in 2022. But for some markets, we may not be able to get a vaccine, full vaccine access to them, even the year after next. So some frontier markets may not receive full vaccine access until 2023. As we go through that process, there are going to be secondary outbreaks. We've already seen this happen. It will continue to happen. As markets reopen before reaching herd immunity, we're going to see secondary waves. But we're not going to see a major simultaneous secondary outbreak that closes Asia, Europe, the US, Latin America all at the same time. Instead, we're going to see governments impose and enforce social distancing measures during outbreaks, even as treatment protocols and outcomes improve. Okay, so those are our assumptions. Where does that leave us? Well, let's take a big step back and look at the global portfolio. What we've done here is we've compared major regions around the world to one another. And we've used a benchmark of 2019 as a whole as a point of comparison. So effectively, we are looking to see when different regions exhibit the economic activity that matches the level that they saw pre-COVID. What you see on the slide in front of you is a pretty clear indication of the divergence between different regions' performance moving forward. The pandemic's impact has been extremely uneven across regions, and Asia Pacific is, without a doubt, the one region that comes out on top in this situation. It's the only region globally whose economy will recover to pre-COVID levels next year. And not surprisingly, based on the conversations that we have had, as well as polling that we've done, many companies, for this reason, view Asia as their top market globally for driving incremental growth. We held a global webinar recently in which we asked the 90 plus attendees on the line which region their business sees offering the biggest revenue growth potential next year. And what you'll see is that Asia Pacific in light blue garnered more than half of the responses. The other responses were split out across regions. This is notable, right? Asia Pacific is outperforming other regions. Its growth is strong. Many companies now are looking to the region to accelerate their growth as it becomes a more important aspect of their portfolio over time. But of course, with that increased attention, in some cases comes an increase in scrutiny. So we wanted to understand how this is impacting you. We actually wanted to run a poll and ask you a question about your experience. We wanted to ask to what degree you're facing additional pressure from corporate to justify plans for Asia relative to years past. We'll give you a little bit of time to answer, a little bit of time for the responses to flow in. Yep. All right. Just a moment. Looks like we may be having some technology issues with the screen sharing. Megan, how are we doing there?
Let me just get this up in just 1 second, Adam.
Okay. In the meantime, maybe I can put this response into a little bit of additional context. What we're seeing in many cases is companies recognizing that while Asia Pacific has been growing its market share as a part of the overall global market, that process has really been accelerated and jump-started by the pandemic. To a large degree, this is an acceleration of trends that we've seen in recent years. We do expect that to continue if we extend the lines that you saw on the last slide out into the future. Megan did send me over the poll results. Apologies for the technology issues. And it's interesting to see that the responses that you all gave very well match up very well with the responses we received during a virtual executive roundtable that we held last week. In this particular case, if we go down the list, about 20% of executives responded they were facing much more pressure from corporate to justify their plans. 40%, a little bit more, said it was more than years past. 20% said it was about the same as before. So what that means is that more than 60% of companies are facing additional pressure, in some cases substantial additional pressure to justify their plans, and less than 20% are seeing less pressure. It's not a huge surprise, right? As Asia Pacific is becoming more important as part of the global portfolio, corporate is paying increasing attention. Boards are asking more and more questions. We're seeing this in our business as we get pulled into leadership presentations and are asked for slides to help Asia Pacific executives justify their position. This is actually a good thing, although it certainly takes a lot more work for the senior executives in the region. But it also has created some challenges because this year, more than any year since probably the late 90s, we're seeing incredible amounts of divergence across the region. Performance levels have been radically altered, but in different ways in different countries for different reasons. So let me explain what you see on the slide in front of you. It can be a little bit challenging to wrap your head around it when you first see it. Basically, what we've done here is we've taken that slide or taken the chart that you saw before, the one where we benchmarked performance to 2019, made that 100, and we split out the lines and set them next to one another. If we were to take the light blue lines here and overlap them, they would look a lot like the last chart you saw. But we didn't want to do that because we wanted to give you a sense of how forecasts have changed over time. The light blue lines are forecasts from 6 or 7 months ago. The dark blue line is from 3 to 4 months ago, and the green line is our most recent forecast. What you'll note is that some countries have seen huge downward revisions to their forecasts. India, the Philippines, look at the difference between the light blue and the green lines. They're huge. Compare that to China, South Korea, Vietnam, where forecasts haven't really budged that much. This is notable. Yes, growth forecasts have been upended for Asia, but some forecasts have been upended more than others. And critically, some of those forecasts remain in flux because of ongoing epidemics domestically, because of shifting dynamics internationally. Market monitoring is going to continue being a major part of companies' jobs, or of executives' jobs moving forward. And critically, parsing out which countries are most likely to exhibit strong and stable growth is going to become a critical element, or be an even more critical element of executives' workflows over the course of the coming quarters. Now, it's all well and good to talk about annual numbers. We think this is useful just to get a sense of which markets are most in flux, but clearly annual numbers are not as good as quarterly numbers. So we actually wanted to dig in a little bit deeper and look at quarterly economic activity with the same sort of framework. So what we've done here is we basically benchmarked Q4 of 2019 to be 100. We're looking at seasonally adjusted numbers here, and basically wanted to map out countries' growth trajectories relative to their pre-COVID levels. And what we see very clearly is that countries that struggle to contain COVID are going to sustain the most long-term economic damage. I draw your attention to the bottom of this chart, right? The lines that really dip and stay low are those that are from countries that have been struggling to a large degree with domestic outbreaks. You'll see this in just a little bit, and actually very soon in our next section. But India, Indonesia, the Philippines, countries where we're seeing sustained, very challenging COVID outbreaks, they're going to suffer from something called hysteresis, or they're more likely to suffer from something called hysteresis. So let me explain what that means. And I'll use the example of a person looking for a job. Let's say you're an executive, you've got a pretty solid skill set at a large company, and for whatever reason you decide, or the company decides for you, that you're going to part ways. You got to the marketplace, you've got a good resume, you've got a good skill sets, good brand name, and you start looking for a job. After a couple of months, if you've got a good story, you're probably going to, in normal times, going to be able to find some roles. People will be interested in you. It's not really a problem. You don't have any gaps in your story, you don't have any issues. But if you take time off, or if you dawdle a little bit, or if you don't take the job search seriously, and you wait 6 months or a year or 2 years, that becomes a lot harder. People begin asking questions. It becomes more challenging. A similar thing happens to economies, although for a completely different reason. When a downturn or an epidemic or some issue hits an economy, initially the economy tends to be able to bounce back pretty quickly. But as more and more businesses see demand for their products drop, cut wages, or even cut people, households begin to feel the pain, and households begin to spend less. In many cases, that weighs on businesses as well. And of course, banks, who are serving this entire economy, are likely to see lengthened loan terms. They're likely to see an increase in defaults. They begin to have problems as well. And as those problems grow, they become less willing to lend to businesses, to households. Over time, this can all create a downward spiral that builds on itself, that makes it a lot harder for an economy to dig itself out of the hole. That can happen in a situation like this as well, which is why large-scale outbreaks for an extended period of time can be really problematic. Now, you'll note there are a couple of countries in that list at the bottom that I did not mention, namely Japan and Thailand. Japan walked into the year a bit hobbled by a consumption tax hike in Q4 of last year. So it was going to have trouble anyway this year, no matter what. And Thailand is just struggling more than anything else with lack of tourist inflows. So it's a little bit of a different situation, although no less painful, particularly for companies that depend on tourism dollars. If we go up to the top of this list, we see that China and Vietnam are on the other side of this. Both have really aggressively contained COVID, and both are actually very well positioned in terms of the global marketplace, in terms of their position within global supply chains to rebound, and that's what they've done. Although the story for China is actually a little bit more interesting. We'll get into that in a moment. South Korea and Malaysia come in somewhere in between. We expect them to recover to pre-COVID levels in basically next year, whereas the others will take a little bit longer if they haven't rebounded already. Now, I mentioned we're going to get into China in a little bit more detail. The reason we want to do this is because it's important to look beyond the overarching economic growth dynamics when possible. So what we wanted to do is break this down further, and we wanted to look at consumption and investment specifically. Let me be specific about what we mean when we say consumption and what we mean when we say investment. Briefly, because of the way that national accounts work out, when we talk about domestic household consumption here, we're not talking about consumption by tourists. We're talking about consumption by people who live within the borders of the country. Okay, export or tourism comes under exports. So what you'll note here is Thailand actually looks pretty good in this chart because this isn't showing the impact from tourism. Investment in fixed assets on the right-hand side basically means investment in any asset that will depreciate over time. This includes plants, equipment, automobiles, whether they be cars or trucks. It includes infrastructure, road, rail, port, airport infrastructure as well. And in this particular case, it also, just to be very straightforward, also includes inventories, which can create some wobbles over time, but generally don't distort the line over an extended period of time. So no need to worry about that. We just wanted to be precise. You may note that the list of countries here does not include Vietnam. That's because Vietnam doesn't release quarterly numbers for consumption or investment. But having said that, Vietnam will come in somewhere on both of these charts between the blue line, China, and the green line. It's easier to see it over here, Korea. So Vietnam's going to come in somewhere between these two for most quarters, just to give you a sense of where it's at. Okay, enough about the details. What are we seeing here? What we see is that across Asian markets, investment levels have diverged much more than consumption levels. If you look at the chart on the right, you'll see that the lines there cover a much wider spectrum of, or much wider range than those on the left. And that goes both ways. China's doing much better, the likes of the Philippines and India, much worse on the right side than on the left. And this is just indicative of the fact that investment levels are more volatile right now. Many B2B companies are seeing a much greater divergence across their portfolio than B2C companies at this point. And we expect that to continue. Although the dynamics surrounding that divergence will change over time. And the winners and the clear losers, well, more the clear losers will also change over time. The winners should largely stay the same. All right, let's dig into this. We'll go one at a time, beginning with the consumption story. So broadly speaking, if we look at this chart, this is the same chart from the last slide, which just blown it up. We see that Asia's domestic consumer market can be broadly classified into three groups. Basically, you got China there at the top, which is going to extend its lead over other markets. You've got South Korea and Thailand, as well as Malaysia, surprisingly, in the middle. We expect them to re-enter positive territory late this year, more likely in early next year. And then we see Indonesia, the Philippines recovering gradually, while India is likely to experience sustained pressure, more sustained pressure than other countries. On India, don't be fooled by good performance in Q4. It's largely going to be due to the festive season. It'll be a bump, which would be welcome, but is a bump nevertheless that won't be sustainable. The the bottom line here is that we see a pretty clear divergence across these three groups that will continue into next year. The notable item here being that Malaysia is probably going to rebound more quickly than most other markets. B2B looks a little bit different. In B2B, in investment, when it comes to fixed asset investment, we see Northeast Asia really winning on this front. Northeast Asia is going to see higher levels of fixed asset investment than South Asia or Southeast Asia. If you take a look at the chart, you'll see that fixed asset investment among the likes of China, Korea, and interestingly enough, Japan as well, is going to outpace other markets, whereas investment in India, certainly, in Malaysia and the Philippines is going to lag this year. We do expect reconvergence later next year, but it's going to take some time to get there. The bottom line here is that we're seeing very divergent performance across different countries, across different types of economic activity. One thing I did just want to note before we wrap up, another item that's important to understand here is, you'll note that China is done remarkably well on the fixed asset investment side, and that actually leads improvements on the domestic household consumption side. The reason for that is because China right now, one of the reasons China's growth looks so good is because the government is pumping a huge amount of stimulus into the economy. It's actually one of the reasons that Japan and Korea's numbers here look as good as they do as well. A lot of stimulus money is flowing into the economy in those three markets. One of the big differences there is China's plowing a lot of that money into fixed asset investments, kind of like it did during the last financial crisis, although not to quite the same extent. So we're seeing a lot of money flow into investment, which is really helping to prop up growth, but which is not actually inspiring a huge amount of confidence or activity, or driving a huge amount of activity on the consumption side of the economy. We believe that will flow down next year, but it's going to take a while. It's going to take a while for consumers to really regain their confidence. And that's why we see a lag in China between the consumption, or between the investment numbers that we saw on the last slide and the consumption numbers that we see here. All right, let me go ahead and move on now to a conversation about how COVID is affecting behavior across markets. Incidentally, just wanted to note, and I know we went through a lot of material pretty quickly in the last section. If you have any questions, comments, please don't hesitate to share them with us. Certainly happy to address them at the end of this session. Let's begin with the conversation on how COVID is affecting behavior across markets with a conversation about what we actually see right now in terms of COVID trends. And to do this, I'm going to exit the full screen mode and play a little bit with this chart just to give you a sense of what's going on. So briefly, what you see on this chart is an area chart where it's stacked up active COVID-19 cases across a variety of different markets spanning Asia Pacific. What do we say? What do we mean when we say active COVID-19 cases? We mean total cases minus deaths minus recoveries. So the number of cases that are actually active in the market. Admittedly, there are challenges associated with gathering this data across any market, but it's nevertheless comparative because we do have countries at least measuring the same things. Over here on the left, you see China, a little blip at this point, and then you see the rest of the countries here, a big wave. But what's notable about this big wave is it's largely being driven by the wedge at the bottom right, which is India. If we remove that wedge, the chart starts to look very different than it did before, right? Suddenly that China bump becomes much larger, and we're left with something that looks quite different. The other two markets that really make up the bulk of the cases Now, the active cases in Asia now are the Philippines, or Indonesia here in green, which I'll remove, and the Philippines here in gray, which I will also remove. Removing those, as well as, let's get rid of Pakistan because it saw a bump in June. We see a very, very different chart. Suddenly, China actually looks like it has a good number of cases. Malaysia's got a problem. Yes, Japan has a problem, but they're not absolutely massive relative to what we've seen in some other markets. That doesn't mean they're inconsequential. It really doesn't, but it is notable nevertheless to get a sense of the actual size. I say it doesn't mean that the smaller outbreaks aren't notable, because very often what drives behavior in response to these sort of situations are government measures in response. So, for example, one of the reasons that we saw such poor performance in Malaysia's consumer environment was because the government pursued a really, really aggressive lockdown earlier this year, and they've since been much, much more targeted with their lockdowns. For example, the most recent one is really just focused on Sabah, where we see the greatest outbreak. So it's important not to focus too much on numbers, although they're important due to the importance of government restrictions, but it's not the only reason. It's also because we have to think about how people respond. What's interesting is if you actually start looking at people's behavior in response to outbreaks, there's a huge amount of variation. To get a handle on what this looks like, we actually parsed a ton of data that's been released by Imperial out of the UK in conjunction with a company called YouGov. These organizations have run consistent polls across markets asking a variety of questions oriented towards the coronavirus epidemic. And so what I want to do now is I want to share some of the results with you. Let me explain what we've done in these charts just to give you a roadmap for interpreting them. So Imperial and YouGov asked a series of questions, several of which involved asking people how often they avoid doing something, avoid going out, avoid going to stores, avoid doing this, that, or the other thing. And people were given the opportunity to basically respond always, frequently, sometimes, not too frequently, or never, something like that. I don't remember the exact, all 5 options, but what we've done here is we basically looked at people who said always or frequently as a percentage of the total, the people who are actually changing their behavior, just to get a sense for how much people are in fact changing their behavior. And we looked at all polls since April and averaged out their responses on the left-hand side, just to get a sense of overall how reticent people feel to do things. And then we also looked at how much the percent of always and frequently responses declined since April. And that's in percentage points. In case any data wonks are wondering, all countries on all of these questions that I'm going to show you saw declines in the always and frequently responses. So this basically pretty much every country has seen more people being willing to go out and do things relative to what we saw in April, when little was understood about the COVID outbreak. But of course, the declines have varied substantially across markets. These polls, by the way, are quite substantial. Most polls included over 1,000 respondents. At the very minimum, you saw around 400. So pretty solid sample sizes. When we look at this chart, what we see is that people's willingness to go out is actually pretty well correlated. It's pretty well linked to the prevalence of COVID in the markets. Remember, I mentioned on the last slide that there were really 3 markets where we see large waves: India, Indonesia, and the Philippines. And so it's not a huge surprise to see that in those 3 markets, we've seen a very high number of people saying they are always or frequently, in this case, avoiding going out in general, and that we haven't seen that change very much over time, which is indicated by the fact that they're on the left-hand side of this chart. So in India, the Philippines, and Indonesia, by and large, a lot of people are avoiding going out in general, always or frequently, and that hasn't really changed since April. The Philippines, India, Indonesia, and notably Korea. You're going to see this happen time and time again. Korea as well, right? It's especially notable because Korea's done a really great job of getting the epidemic under control within their borders. They're lauded as an example internationally. And yet, individuals within the country do not respond as one would expect. In contrast, people tend to show the greatest tendency to revert to their previous behavior in markets that have brought their initial outbreaks under control, notably China, Vietnam, and Thailand. Thailand's done a good job with this. But they're not the only ones. Japan is another country where people show the greatest tendency to revert to their previous behavior. In Japan's case, actually have the least number of people changing their behavior. Northeast Asia stands out here. Developed Northeast Asia stands out here as a bit of an exception to the general rule. Now, if we move on and we look at other questions that were asked, people's willingness to go to other places, the responses change a little bit. So here you see the exact same question, except instead of, or the exact same setup, except instead of asking how often people avoid going out, we've asked, or the Imperial and YouGov asked, how often people avoid going to a hospital or another healthcare setting. And we see very clearly is that these dots have shifted to the left and up. People show greater reticence to visit hospitals than other places. Not a huge surprise, given concerns about COVID concentration, shall we say, in healthcare facilities. What's interesting is that this reticence extends to countries that brought initial outbreaks under control. So in addition to the Philippines, India, and Indonesia, and notably Korea, Korea's still there, we also have Malaysia and Vietnam. Vietnam in particular has done a great job of bringing COVID under control. Malaysia, a little bit less so, but it's done a reasonable job. And hey, we could, could have even just extended this circle to include Thailand. Thailand's not too far off, and Thailand's done a great job as well. Once again, though, if we were to look beyond this circle, Japan stands out as an outlier. As a minority of patients actively avoiding healthcare facilities. And we've seen people flow back into healthcare. More people demonstrate a willingness to stop avoiding healthcare settings in Japan than anywhere else except for China over time, which once again is quite notable. Let's change gears a little bit and talk about work. We've talked a lot about working from home. It's certainly an important element of so many of our workflows. We see broad brushstroke trends across Asia in this front, but there are also substantial variations that are notable. When asked how often people avoid working outside their home, you'll see that we don't have a whole lot of dots in the upper left-hand corner of this chart like we did with healthcare facilities, because people are changing their behavior. They are going back to work, in some cases in very large numbers. And in many cases, we actually see, on average, most people working outside their homes, or I should say, more accurately, not avoiding working outside their homes. Less than half of respondents across all the markets that you see circled here now report actively avoiding their work. And in some places, particularly in Malaysia, we've seen huge numbers of people flow back into workplaces. This is notable for any company that sells into office spaces, who basically has major retail outlets underneath office spaces or near office spaces. This is a notable finding. We certainly are seeing many, particularly white-collar workers, continue to work from home. And to some degree, that will likely continue well into the future. We had an extensive conversation during the virtual executive roundtable about changes in office space and what would be permanent and what would be temporary. But the point here is that we are seeing much greater changes in behavior across these markets when it comes to working than we've seen in the other questions that are more general and are more healthcare facility focused. There are two notable exceptions here, though, and they're India and the Philippines. In India and the Philippines, we see, although people have started to flow back to work, we still see a great deal of individuals who always or frequently avoid working outside their home, likely out of fear for what's taking place. We'll wrap up briefly with a discussion on bricks and mortar as well. So this last question is focused specifically on going to shops. What we've done here is, or what was done here was Imperial and YouGov basically asked how often people avoid going to shops, and we parsed it the exact same way. And you'll note that once again, the dots have moved quite substantially. What's notable here is that no matter where you look, large numbers of people are avoiding bricks and mortar shops. Take a look at the axis on the left-hand side. Even Malaysia or Indonesia or Japan, where on average, fewer numbers of respondents are always or frequently avoiding going to shops. I mean, you're still talking about a substantial portion of the population in those markets, which basically means that investment in digital channels are probably going to offer outsized returns in the short to medium term. It doesn't matter which of these countries you look at. Having said that, though, there are some markets that are probably going to offer you more payoff than others. So what we've done here is we've highlighted South Korea and India in particular as areas where you're probably going to see greater payoffs. In Korea and in India, we see a much greater degree of reticence to go to shops, which means people will be driven more towards digital channels. And in Korea, we see a really strong digital infrastructure already in place. And in India, we see a very rapidly growing digital infrastructure that is enabling activities that weren't possible 3 years ago, 2 years ago. Heck, at this point, not even possible 6 to 12 months ago. So those are areas where you're probably going to see more dividends from any sort of investments that you make. This doesn't mean that the other markets don't offer opportunities. They absolutely do. Certainly, if you're not investing in digital in China, or at least thinking about it, it would be good to do that regardless of what's on this chart, just because of how important it is and how fast moving it is. But for executives who have limited resources that they're trying to allocate, I wanted to highlight this analysis as food for thought. Now, this behavior will not last forever. We've gotten good news in recent weeks about multiple vaccines that appear to be quite effective. And here's hoping that they all prove to be safe and are quickly approved. But even if that happens, it's not exactly clear when we'll see behavior return to normal. So we wanted to do a couple of things to wrap up this section. First off, ask your opinion on timelines, and then second, offer you a view on a market by market basis. But let's begin with the poll. So Megan, if you could open that up, we'd like to know from your perspective, after a vaccine's approved, how long it will take for people to begin adjusting their behavior. We'll let those answers flow in. All right. Here we go. So I've gotten some very interesting results. So basically, it's pretty clear that the majority of individuals on the line feel that individuals will start cautious but loosen up as the vaccine is administered. Outside of that, there were some individuals who felt that their adjustment would begin after the vaccine starts being administered, or wait, or people would wait until authorities confirm herd immunity, then adjust. But by and large, the answer here is pretty clear. This doesn't align exactly with the virtual executive roundtable that we held, or the responses from the virtual executive roundtable that we held last week, in which we saw more optimism about people adjusting their behavior soon after the vaccine was approved. But by and large, the result that you all gave us is pretty well aligned in that the clear answer is starting cautious but loosening up as the vaccine is administered, right? So basically, as we think about, these polling results suggest is that as we think about timelines, we have to think about not just vaccine approvals, but also vaccine distribution and rollout. Now, what does that mean? Well, what that means is we have to look at this on a country-by-country basis, and we have to use that framework for thinking about where we're most likely to see behavior normalize first, and in some cases where we may not see behavior normalize for quite some time. What we've done here is we've laid out very rough timelines for full vaccine access across markets in Asia. I want to be abundantly clear. We don't actually know that full vaccine access will take place along the timelines stipulated here with a great deal of precision. Actual timelines are going to depend on a variety of factors, including efficacy, safety, approvals, supply chain requirements. I mean, in many cases, we don't know whether the vaccines are actually safe. We haven't seen vaccines actually get approval from European or from American or European regulators, Japanese regulators, Aussie regulators. The Chinese government seems to have given emergency approval, certainly for some of its vaccines, and they have been rolled out en masse, but there we don't actually have any efficacy results, right? So there's a lot to this analysis that we'll have to conduct after the details become clear, because the details will really matter. Having said that, it is pretty clear if you look at advance orders of different vaccines, if you look at the supply chains that are in place, if you look at wealth levels and how much people are actually willing to pay to get vaccinated or to get protected from the virus more accurately, it's pretty clear that wealthier markets with more developed infrastructure are likely to get full access to vaccine before others, which is going to allow their people to revert to pre-COVID behavioral patterns more quickly. Whereas markets with less money, with more complex geographies, with weaker infrastructure and larger populations, they're not going to be able to pay as much for the vaccines. They're probably not going to be right at the front of the line. They have a much heavier lift on their hands in terms of distributing the vaccines, administering them. And so there, it's going to take a little bit more time to get full vaccine access. And as a result, their people are likely to exhibit COVID-driven behaviors for an extended period of time. And as noted before, frontier markets, it could take a little while to get to them. Like Myanmar, Bangladesh, their people are probably going to exhibit COVID-driven behavior for quite some time. So hopefully it gives you a sense of what to expect over the course of next year, where we're probably going to see behavior revert relatively quickly, and where, looking at some of these charts in previous slides, we're likely to see behavior linger for an extended period of time. Well, I know that we're coming up towards the top of the hour, and I want to make sure that we leave time for Q&A at the end. So what I want to do now is turn to our final topic of the day, which is it's just an update on the US presidential election. We're not going to go into a huge amount of detail here, but we wanted to provide a clear-eyed view on some of the most common questions that we've been receiving over the course of recent weeks. And to do that, we'll begin by cutting through all the noise about the US election. Joe Biden will become president of the United States on January 20th of next year. There's been a lot of discussion around the validity of the election results, questions about fraud, et cetera, and the Trump campaign has certainly been very active within the US judicial system, bringing a variety of different cases to court across key states. Regardless of your view of the legitimacy or the validity of those cases, the outcome at this point is quite clear. Although President Trump's lawsuits will continue to wind their way through courts, states are facing deadlines to certify their votes. December 8th is called the safe harbor deadline. And that's really when states need to, or are supposed to officially name their electors. As a Floridian, I remember when this deadline was used to call the Bush-Gore election a couple decades ago. And with that deadline fast approaching, it's becoming less and less, the path for any sort of lawsuits to change the outcome becomes less and less realistic. Indeed, it's already becoming pretty unrealistic. By the time we reach December 14th, this entire thing will be over, because at that point, electors will officially meet in their states and cast their votes. This will lead to a series of events up through January 20th, when at noon, the next president and vice president will be sworn into office and the transfer of power will be complete. Briefly, I know I may get pushback on some of what I've said. So for those who still question it, there's a great editorial in the Wall Street Journal by Karl Rove in which he basically outlined how frequently statewide electoral contests had been overturned during recounts. And in the last 50 years, it's happened 3 times. And in all 3 of those times, the differential in votes was less than 500. The differential in the states that we're looking at now are in the tens of thousands, or in some cases more than 100,000. It's extraordinarily unlikely that we're going to see anything change. And so right here and now, you can begin planning, if you have not already, for a transition of power on January 20th. It's important to note, just briefly, that Mr. Trump will maintain his role as US president, all the power that comes with it, until power is officially passed. So we very well may see some additional rules and regulations come through. It's very important to note. But you can begin planning for that transition. What does that mean? Well, I'm not going to dig into this in a huge amount of depth, because we did an entire session in which we talked about US-China tensions and the differences between the Trump and the Biden administration. But we've got them outlined here. And the important thing to note is that Biden's election will lead to changes in some, but not all, of the US's policy stances on China. If you look at the box at the bottom, those are all the areas where we will not see the US's policy stance on China change. In some cases, for example, when it comes to Xinjiang, Hong Kong, we may very well actually see the Biden administration ramp up its efforts relative to what we saw under Mr. Trump. But having said that, there are some key changes. We're going to see more traditional policy formation and alignment. We're going to see a preference for multilateralism over unilateralism. And it's extremely unlikely that we're going to see additional tariffs be levied by the Biden administration. Biden is not a self-proclaimed tariff man. He doesn't really orient in that direction. And so that's not his chosen foreign policy tool. But that naturally leads to the question, well, then will Biden actually remove Trump's tariffs? And the answer to that is probably not, with one key exception. There's one potential exception that I'll note in just a moment. Why? Well, take a look at the chart on the left-hand side. What you see there is the trade-weighted average tariff rate as calculated by the Peterson Institute for International Economics, the tariff rates between China and the US. The light blue line is China's tariffs on exports from the US to China. The dark blue line is the exports that the US puts on Chinese exports to the US. What you'll note is that back in January 2018, there was a pretty substantial gap. And while tariffs have gone up over time, they've basically come to a point where they're approximately equal. Like it or not, like whether or not you like Mr. Trump, we can't deny the fact that in many cases, he did work to equalize uneven tariffs across borders. And it's not just the case in China, it's the case in a lot of different areas. What does that mean? Well, it means that Biden doesn't have that many reasons to remove the tariffs. US and Chinese rates are now about equal. And perhaps more importantly, if Biden changes the tariff rates, he owns them. If he doesn't change them, he can just blame Trump. It's a tried and true feature of US politics. It's not just a Biden thing. Mr. Trump did it before him, Mr. Obama did it before him, Mr. Bush did it before him. It's standard practice. But there is one exception to this, and that is the September 1st round of tariffs. If you look at the way that the US levied tariffs, it was actually pretty well thought out in terms of the details. What I mean by that is that the US was at pains to avoid raising tariffs on consumer goods, and particularly to avoid raising tariffs on consumer goods that couldn't be sourced anywhere else in the world. Initially, that was fine. That's why most of the tariffs focused on B2B goods. But by the time we got to last September, the Trump administration was running out of products to slap tariffs on. And so the September 1st round of tariffs ended up including a lot of consumer goods, 40% of consumer goods that were exported from China to the US. And that arguably did more damage to American consumers than any of the other rounds of tariffs. This is probably the first round of tariffs that Biden put on the table. He may not do it unilaterally. In fact, Biden's probably not going to remove any of the tariffs without concessions from the Chinese side. But this one probably the first one up for serious conversation, because it would have the potential to ease pressure on the US economy at a time when the US economy could really use it. All right, come to the end of the content-oriented part of the section. I know we're coming up on time, so let me turn now quickly to the Q&A portion. If you have any questions, please by all means share them with us via the GoToMeeting messenger by sending them to Frontier View Webinars. All right, we've got a few that have come in, and I want to make sure that we give them the attention they deserve. So we'll go maybe a few minutes over time and answer them here. So the first question was, how long will it take other regions to return to the economic activity levels seen before COVID? So this is basically a reference to the first chart that I showed with the lines in the different regions. So Asia Pacific is expected to return to growth next year, which is great. And most regions, including North America, are currently slated to do the same in 2022. There are some notable exceptions. LATAM will take a little bit longer, and Western Europe is currently expected to take quite a bit longer than other regions. So we'll probably see LATAM return to pre-COVID levels of economic activity in 2023 and Western Europe in 2024. Now, these numbers do remain in flux. We actively reevaluate our forecasts on a monthly basis because there's so much dynamism built into the current environment. But that is our current view. All right, question 2. In terms of timelines, where does Australia fall on your map? So this is a reference to this map, I guess. Australia is very much in the green category. It has vaccine orders to a couple of different major multinationals and should be pretty well covered. In our recent events to watch report, which I highly recommend everybody take a look at if you have a moment. We actually outline which countries have already pre-ordered vaccines and how many vaccines they've ordered relative to the size of their population. It's quite telling. A number of markets have ordered vaccine in many multiples of their population size, suggesting that they're reasonably well covered. Australia isn't at the top end of that range, but it looks like it should be in pretty good shape. Last time I checked, New Zealand wasn't quite as well covered, but in the vein of the analysis here, I'd be surprised if they weren't able to secure supply pretty quickly. Once again, wealthier market, well-developed infrastructure. They're going to be able to get access to, well, they will be able to distribute and probably bid for quite successfully for a variety of different vaccines. So ANZ should be pretty well covered. All right, let's see. We'll do one more question and then wrap up the session. To what degree will the Republicans support Biden on any push to build a coalition to confront China, particularly if Trump is tweeting on the sidelines? Okay, great question. Here's a short answer. The Republicans are likely to line up behind Biden on this one. I don't know if you all saw it, but this month, the Senate Foreign Relations Committee, which is chaired by a Republican who signed his name to this document, recently released a report. It's something to the effect of, I don't remember the exact name, but it's like a concrete agenda for transatlantic cooperation. Anyways, this report, it's worth looking up, outlines a number of substantive areas where the US would like to collaborate with European colleagues to address challenges posed by China. Although it may not have seemed this way over the last couple of years in particular, there is undoubtedly appetite within the Republican Party to pursue a multilateral approach, even if it's done under a Biden administration. And we see that in the introduction to that particular report. It's worth a look if you have a moment. All right, we're a little bit over, and so I feel the need to go ahead and wrap us up. If there are any questions that we were unable to answer on the line today, we'll be sure to follow up with responses through your client services manager. Everyone will also receive a recording of the presentation within 24 hours. You can view these webinar materials and much more on our new mobile app, which is available for download right now on iOS or Android. And once again, for complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, please email us at info@frontierview.com, and a member of our team will be in touch. Before we conclude, I would like to finish this webinar by highlighting several actions to take that were outlined throughout this session, just to wrap it all up with a nice bow. I will start from the top. Asia is going to come under a lot more scrutiny. We saw this in the poll that we took today. I've heard it from clients across a variety of different industries. So prepare to spend more time managing up and managing internal narratives as headquarters sees Asia post remarkable growth relative to the rest of the world. With great power comes great responsibility. Secondly, use our quarterly forecast to manage corporate perceptions, clarify recovery timelines, and inform conversations on portfolio allocation. We're seeing more divergence across Asian markets now than we've seen in a very, very long time. Third, utilize our data on COVID-driven behavior to inform conversations on demand planning and digital investments. People are not all responding to COVID outbreaks or the fear of COVID outbreaks in the way that you would necessarily expect them to. So understanding people's behavior is key to making well-informed investments. Fourth, build your plans on the assumption that Joe Biden will be the next US president. You don't need to wait until Mr. Trump's court cases wrap up. It's pretty clear what's going to happen here. And as a result, you can plan for most US tariffs on China to remain in place for the foreseeable future. There is one exception. That's the September 1st tranche of tariffs. It may or may not happen, but particularly if you're a B2C company, or if you sell into B2C companies, it would probably be worth your while evaluating how the removal of that tranche could impact your business. Very good. We'll leave it at that. Thank you everyone on the line for joining us today. That concludes our webinar. We look forward to speaking with you again soon.